Welcome back to the deep dive. Today, we are stepping into the ring for what I honestly think is the heavyweight championship of the financial world.
I mean, that's not an exaggeration.
And I don't use that term lightly. We aren't just comparing, stocks versus bonds or growth versus value here.
No.
We
Yeah.
are talking about a philosophical cage match. It is the boomers versus the zoomers.
The shiny rock versus the magic internet money.
Exactly. It really is the ultimate showdown. We're looking at gold versus Bitcoin.
And frankly, the timing couldn't be better because the noise around this debate has never been louder.
It really hasn't.
Both assets have been hitting record highs recently, but for completely conflicting reasons. It's a fascinating dynamic.
It feels like everyone has retreated to their corners, You have the gold bugs who think the financial system is collapsing and want to hug their bullion in a bunker. And you have the Bitcoin maxis who think the system is collapsing and want to upload their wealth to the cloud.
And our mission today is to try and cut through that noise. We've gone through a massive stack of debates and analysis.
A lot of material.
A lot. Featuring the likes of gold diehard Peter Schiff facing off against crypto heavyweights like Jack Mallers and Binance founder CZ. We're going to try to settle the debate.
Or at least explain it.
It. Which one actually belongs in your portfolio?
Okay, so before we start throwing punches, we need to set the stage. Why is this heating up so much right now? Is it just hype or is something structural happening?
Oh, it's definitely structural. I mean, according to sources we looked at, the market is currently priced for perfection.
Which is a polite way of saying everything is incredibly expensive.
Exactly. And investors are getting nervous. There's anxiety about inflation, geopolitical instability, and just the sheer amount of money the governments are printing.
So people are looking for safety, a margin of safety, to quote the classics. They want an asset that isn't going to just vanish if the stock market takes a tumble.
They do.
Yeah.
And right now, the discrepancy between these two safety nets is massive. This is a point that often gets lost in, the crypto Twitter hype.
Okay.
To give you a sense of scale, gold has a market cap of somewhere between, let's say, $14 to $20 trillion.
Wow.
Depending on how you count jewelry and all that.
Mm-hmm.
Bitcoin is sitting around 1.6 trillion.
So to put that in perspective, gold is the ocean and Bitcoin is a very, very large lake.
A very large lake, exactly. Gold is still the 800-pound gorilla.
Right.
But Bitcoin is the gorilla that grew 1,000% while the other gorilla was taking a nap.
Okay.
But let's not get ahead of ourselves. To understand the challenger, we first have to understand the champion.
Let's start there. Round one, the case for gold. You're the historian here. Why, in the age of AI and space travel, are we still so obsessed with a yellow metal that we dig out of the ground just to put it back in a vault?
It comes down to two words, tangibility and history. And Peter Schiff makes this point repeatedly in his debates. And honestly, it's difficult to argue against 5,000 years of history. You can't fake gold. You can't hack gold. And more importantly, if the internet goes down, if the power grid fails, your gold is still there.
Schiff uses that example of the dental filling, right? Which I have to say is a very specific flex.
It is, but it illustrates his point about intrinsic value. He says you can't make a computer chip, a dental filling, or a bracelet out of Bitcoin. His argument is that for something to be money, it first needs to be a commodity. It needs to have value independent of being money.
Okay.
If nobody used gold as money, people would still want it for jewelry, for industry.
But I have to push back on that, though. Isn't that the classic rock argument? Ooh, I can touch it, therefore it has value.
Sure.
I mean, I can touch a pile of dirt in my backyard, but I can't trade it for a Tesla. Just because it's physical doesn't mean it's valuable.
That's a fair pushback. And the crypto side, they love to mock that pet rock mentality. But here's where it gets interesting. It's not just about looking pretty.
Okay.
Gold has critical industrial utility. It's used in aerospace, in high-end electronics, in medicine. It conducts electricity without corroding. So there is a floor to its price based on that utility.
Okay, so it has a safety net of actual use.
Right. But the biggest argument for gold right now isn't about dental fillings or circuit boards. It's about who is buying it. And we aren't talking about your uncle buying a coin at a pawn shop. We're talking about central banks.
The big guns.
The biggest guns.
Yeah.
I mean, we looked at reports, and the data shows that countries like China, Russia, Poland, they're buying gold at record rates.
Why? Are they just fans of shiny things?
It's about de-dollarization.
Ah,
They're trying to reduce their reliance on the U.S. dollar. If you're Russia or China, holding U.S. dollars is a massive risk because the U.S. can sanction you.
right. They can freeze your accounts.
But they can't freeze a bar of gold sitting in a vault in Beijing.
Precisely. It is a sovereign asset.
Well,
It has no counterparty risk.
and here's the kicker for the crypto crowd. These central banks are not buying Bitcoin to solve this problem.
Hmm.
They're buying gold. And that is a massive signal from the smart money.
That is a strong point. If the people who literally print the money are trading it for gold, that says something about their confidence in their own product.
It certainly does. And, in terms of performance, it might surprise you. Kai's analysis showed that over a specific recent one-year period, gold actually outperformed both Bitcoin and the S&P 500.
I saw that.
He's been the quiet achiever while everyone's watching crypto charts.
It definitely holds its own. But I have to bring up the inflation hedge argument. The sources seemed a bit conflicted there. We always hear gold as the hedge against inflation, but does the data actually support that?
It is nuanced. It is.
Yeah.
Gold hasn't perfectly tracked inflation year over year since the 1980s.
Right.
Sometimes inflation goes up and gold stays flat. But the argument is about the long haul. Over centuries, an ounce of gold roughly buys you a nice suit.
Mm-hmm.
In Roman times, it was a toga and sandals. Today, a bespoke suit. It retains purchasing power.
Whereas the dollar.
The dollar has lost about 97% of its purchasing power since the Federal Reserve was created. Fiat currency, which is money backed by nothing but faith and credit, it eventually returns to its intrinsic value, which is zero. When that faith shakes, people want the physical stuff.
Before we leave the gold corner, though, we have to talk about Peter Schiff's favorite attack on Bitcoin, the Satoshi argument.
Oh, yeah.
I laughed when I read this in the transcript, but he seems dead serious.
Oh, this is classic Schiff logic. He argues that Bitcoin isn't actually scarce.
Wait, isn't scarcity the entire point of Bitcoin? The 21 million cap. That's like the first thing you learn.
It's what everyone says. But Schiff looks at it differently. He says, yes, there's a cap of 21 million Bitcoins.
Okay.
But each Bitcoin can be divided into 100 million smaller units called Satoshis. So Schiff does the math and says there are 2.1 quadrillion Satoshis.
Okay. But that's just units of measurement.
Well, he says, how can it be rare if I can keep slicing it into smaller pieces? There are enough Satoshis for everyone on Earth to have hundreds of thousands of them. In his mind, the scarcity is an illusion because the units are so divisible.
That sounds remarkably like someone who doesn't understand math. That's like saying a foot isn't a fixed length because I can divide it into infinite nanometers.
It is a provocative way to look at it.
Yeah.
But it brings us perfectly to round two, the case for Bitcoin.
Yes.
Because Jack Mallers, the CEO of Strike, had the perfect rebuttal to that slicing argument.
The pizza analogy. I loved this.
The infinite pizza.
Right. Mahler's basically said, Peter, imagine we order a pepperoni pizza. If I slice that pizza into 4 giant slices, or if I take a laser and slice it into 1 million tiny microscopic crumbs, do we magically have more pizza?
No. You just have 1 million tiny crumbs. You haven't increased the calories of the mass.
Exactly. The total amount of pizza is absolute. The 21 million cap is the size of the pie. How small you slice pieces to sell them doesn't change the supply.
And that is the critical distinction. In fact, if we connect this to the bigger picture, that hard cap is what Bitcoin proponents argue makes it harder money than gold. Because here's the thing about gold. We don't actually know how much is left in the earth.
True. If the price of gold goes to $10,000 an ounce, suddenly it becomes profitable to mine really deep or mine the ocean floor.
Or eventually mine asteroids. The supply of gold is elastic. If the price goes up, humans are very good at finding more of it.
Right.
We cannot find more Bitcoin. The code dictates the supply. 21 million. That's it. No matter how high the price goes, no more will ever be created. That is absolute scarcity.
So Bitcoin wins on scarcity math. But the case for Bitcoin isn't just about scarcity, it's about utility. Jack Mallers called Bitcoin the only monetary asset you can teleport over a communications channel.
Teleporting money, it sounds sci-fi, but I mean, think about the friction of the legacy system.
Yeah.
If you want to send a gold bar to London right now, how do you do it?
Expensive shipping, insurance, armed guards, customs, it takes days.
Exactly. And CZ from Binance gave a real-world example that was pretty grounding. He talked about a user in Africa.
Yeah.
Before crypto, this person had to walk 3 days, literally 3 days of travel, just to pay a utility bill physically with cash.
3 days. Wow.
Because the banking infrastructure wasn't there. After crypto, he paid it in 3 minutes from his phone.
That is undeniable utility. That represents a friction cost reduction that changes lives.
Right. And CZ's point was that utility is value. Schiff argues Bitcoin has no value because you can't wear it.
Mm-hmm.
CZ argues that Google and the internet have no physical weight,
Mm-hmm.
but they are immensely valuable because of what they do.
Okay, but I have to play devil's advocate here. In the debate, Peter Schiff, who I'm kind of channeling a bit,
Go for it.
he countered this portability argument with the concept called tokenized gold.
T-gold.
Right. Schiff's argument is, if you like the speed of crypto, why not just put gold on the blockchain? You get the stability of the metal, but you can zip it around the world like an email. Why deal with the volatile coin when you can just digitize the rock?
And this is where the debate got philosophical. Because Jack Mallers hit back hard on this.
He did.
He asked a very simple question. Sure, you can tokenize gold, but where is the gold?
In a vault.
Exactly, it's in a vault, which means you have to trust the guy with the key. You have to trust the bank, the government, or Peter Schiff's company not to steal it, or lend it out, or have it seized by a regulator. Gold, by nature, centralizes. You need security to hold it.
That brings up the bearer asset argument. Can you unpack that for us? What exactly does that mean?
Sure. So cash is a bearer asset. If I hand you a $20 bill, you hold the value. The transaction is done.
Right, no middleman.
No middleman.
Yeah.
Gold is a bearer asset. If you hold the coin, you own the wealth. But the moment you try to send gold digitally, it stops being a bearer asset. It becomes a liability. You are holding a receipt, an IOU, for the gold.
And Mahler's point is that Bitcoin is the first time in human history we have a digital bearer asset. I can send you $1 billion in Bitcoin, and the settlement is final.
Final.
No bank, no government, no vault manager involved.
And that is the crucial trade-off. With gold, you trust physics and custodians. With Bitcoin, you trust code and the network.
Right.
And looking at the demographics from our sources, it's clear who trusts what. Bitcoin is the store of value for optimists.
Yeah, younger, tech-forward.
Younger people who believe in the network. Gold is for the pessimists, hedging against disaster and trusting physical reality.
Okay, so we have the case for the rock, history, and the case for the code, portability, and scarcity. Let's move to round 3, the head-to-head. We have to talk about the elephant in the room, the thing that scares most people away from Bitcoin, volatility.
This is where Schiff lands some heavy blows. He pointed out, that the data backs this up, that in the 4 years leading up to his debate with CZ, Bitcoin was actually down 40% when priced in gold.
Ouch. That's a tough stat for the crypto guys.
It is a massive drawdown. He calls it a terrible inflation hedge because it's so unstable. If you bought the top in 2021, you were still hurting in real terms compared to gold.
Right.
He argues that a store of value shouldn't drop 50 or 70% in a year.
But then you have the counter-argument, which is always zoom out.
Sure.
If you look at a 5-year, 10-year, or really any long-term horizon since its inception, Bitcoin crushes everything.
Oh, absolutely.
It eats gold for breakfast. It's all about your time preference.
True. But high volatility kills short-term investors. If you need that money next month for a mortgage, you can't have it dropping 20% overnight.
Fair point.
And this raises an important question about the new way people are buying these assets. The ETFs.
The paper Bitcoin?
Exactly. We have gold ETFs and now Bitcoin ETFs. This means you can buy them in your stock brokerage account. But Schiff warned about a specific risk here. He calls the ETF buyers tourists.
Tourists, meaning they aren't there to stay.
Exactly. They aren't the diamond hands true believers who will hold through a crash. They're Wall Street speculators.
Right.
And Schiff predicts that if the price drops, these tourists will panic sell first, creating a trapdoor crash in Bitcoin. Whereas gold holders, particularly those central banks we mentioned, they're strategic. They never panic sell.
That is a scary thought. A trapdoor crash caused by paper hands. But speaking of Peter Schiff and panic, we have to talk about the hypocrisy check.
Oh, yeah.
This was my favorite nugget from the sources.
I think I know what you're going to say.
Peter Schiff, the man who has spent a decade bashing Bitcoin, calling it a scam, calling it rat poison, launched an NFT collection on the Bitcoin blockchain.
Golden Triumph.
Golden Triumph. It's a digital art collection of a hand holding a gold bar.
You have to appreciate the irony. Even the biggest skeptic couldn't resist the market opportunity.
It's unbelievable.
It really shows that even the enemies of crypto recognize the technology has some utility, even if just for marketing.
Or just for making a quick buck. But it does blur the lines a bit, doesn't it? It
Yeah.
suggests that the wall between these two worlds is kind of crumbling.
It does, and I think that leads us to the most surprising part of our research.
Hmm.
Despite all the yelling, despite the rat poison versus pet rock insults,
Yeah.
these two sides actually agree on the most fundamental problem.
They do. In that debate, things got surprisingly civil at the end. Mullers and Schiff agreed that the real enemy isn't each other, it's fiat currency.
Right. They both believe the current financial system is broken. They both believe money printing creates inflation that steals your wealth.
Hmm.
They're just betting on different lifeboats. Gold is the lifeboat that has worked for 5,000 years. Bitcoin is the speedboat that was built for the digital ocean.
I like that analogy. So what does this all mean for the listener? You know, we've got the listener sitting there looking at their 401k or their savings app. What do?
Yeah.
Do they buy the lifeboat or the speedboat?
Well, we can look at the advice from Kai in the Smart Money Source. He breaks it down quite sensibly. He suggests avoiding the all-or-nothing mentality.
Right.
You don't need to join a cult to make money.
So no selling the house to buy Dogecoin.
Please don't. Kai suggests that for a conservative investor, a 5 to 10% allocation to gold acts as that stabilizer, that insurance policy.
Right.
It drags on your returns when stocks are hot, but it saves your portfolio when the world is on fire.
And for the aggressive investor.
Maybe 0 to 5% gold, but heavier on the tech and Bitcoin side. But the key takeaway was the 3-pillar strategy.
Break that down for us. What are the pillars?
Pillar 1 is real estate where you live, tangible property.
Okay.
Pillar 2 is equity stocks, ETFs, productive companies that generate cash flow. And pillar 3 is the hard asset slice. This is your insurance against the dollar failing. The debate is just about what you put in that hard asset slice. Do you fill it with gold or do you fill it with Bitcoin?
It seems like the smart move is acknowledging that they serve different roles. Gold is wealth preservation. It keeps you rich. Bitcoin is wealth generation. It can make you rich, but with a side of heart attack-inducing volatility.
Precisely. And if we look at the trend, with central banks digitizing their own currencies, the lines are they're blurring.
That actually brings me to a final thought I wanted to throw at you. We talked about tokenized gold, we talked about Bitcoin, we talked about central bank digital currencies.
Yeah.
In 20 years, do you think the distinction between physical and digital money will even exist? Or will it all just be different flavors of code?
That is the provocative question. If I can own gold but never touch it and spend it via a token on my phone, is it physical? We're moving toward a world where value is just information. Whether that information is backed by a rock in a vault or a decentralized network of computers might matter less than the efficiency of the transaction.
A world where money is just information. That is something to chew on. It suggests the Zoomers might have already won the philosophical war, even if the Boomers still own all the gold.
It's possible. But for now, as the voice of caution here, I'd say, check your risk tolerance before you buy the digital lottery ticket.
And as the optimist here, I'd say, don't get stuck in the Stone Age. Maybe the answer isn't gold or our crypto. Maybe it's just not fiat.
I think that's a compromise we can live with.
That's a wrap for this deep dive. Let us know. Are you team gold, team crypto, or are you just hiding cash under your mattress? Thanks for listening, and we'll see you in the next one.
Like and subscribe.